Hi, good afternoon, everybody. Welcome to our webinar today. Let's do a quick sound test. Can you hear me? You just type in the text box so you can hear me, so we can go forward quickly. Welcome to our webinar. We're going to discuss moving averages. It's a bit of technical analysis today. Might take a bit longer than 30 minutes. We'll see how it goes. Okay, we've got a lot on the agenda. So here's the agenda for today. Thanks for answering there. Thank you. So you can hear me. So we're going to discuss moving averages, a quick introduction, and obviously focus a lot on what the primary function of moving averages, and discuss quickly the differences between a simple moving average, exponential, a weighted, a moving average, and which are the best moving averages to work with. And then spend some time on discussing moving average crossovers, and then a quick introduction into Bollinger bands. But these are very simple technical tools that I use all the time, and I love them, and hence the webinar today. Okay, great. So let's move forward. What are moving averages? Basically, moving averages do two things. They smooth and lag, and they smooth out the price chart. Also, what they do is they show key turning points in the market. When I say smoothed, obviously it reveals the basic movement or patterns of the price, be it a bar chart, a line chart, or a candlestick chart, without obviously the distracting or misleading noise, what we call the daily fluctuations. When I say lagged, it mirrors the essential wave formation, but obviously it's delayed. When I say it's delayed, obviously it doesn't predict any new trends. It confirms after the trend is established. So it's a lagging indicator. There's two groups of indicators. We get what we call lagging indicators and leading indicators. We're focusing obviously on moving averages, which are lagging indicators. So some people might say that is a disadvantage, but the main disadvantage of moving averages is that it doesn't work in a sideways market. When the market is trending sideways, it's basically useless. It's better for a trending market where we have a distinct trend up or distinct trend down. That's where they work very effectively. So the main disadvantage, obviously, is that it doesn't work in a sideways market, and you'll see a screenshot just now what I mean by that. So what are the purposes of moving averages? As I mentioned just now, they smooth out the daily fluctuations in the share price, so the basic trends can be seen. So they provide a benchmark. So obviously you want to compare the share price to the moving average, and you want to judge for yourself whether a reversal has begun. Remember, you as a trader, you want to trade the trend, and also obviously you want to trade in the direction of the trend. So if you can identify the trends and make those trends work in your favor, you'll be increasing your number of winning trades and obviously making money from that. There's four basic functions of a moving average. To identify obviously trends and reversals. We'll discuss this in more detail in the next few slides. They highlight or measure the strength of the momentum, okay, the underlying movement of the market. Also highlights area of support and resistance. I use that a lot. It also helps us to generate a very simple trading system and confirms data, especially on other indicators, and you'll see some examples just now too. So let's go into more detail regarding the primary functions. In the uptrend, obviously the price is above a moving average, and you'll see some screenshots just now what I mean by that. So there's some rules involved. If the price is above a moving average and the slope is upward, we can say that is a upward trend, and you'll hold the position until such time as the trend changes. In the downward trend, when the price is below a downward sloping moving average, that will confirm a downtrend. Obviously, you might consider opening up a short position on single stock futures or CFDs when that happens. So it's a very simple rule, obviously, that works in your favor. Okay, and I see this happening all the time. I use it with live charts. I use it with end-of-day charts. Doesn't matter what time frame you're using it. These things do work. The second thing that you use is what we call momentum. What's important here, obviously, is the time period being used. Different types of momentum, obviously, to take the different time periods. A short-term momentum will be anything less than 20 days. A medium-term momentum would be anything between 20 and 100 days. And long-term momentum would be anything between 100 days and more. So, for example, it's just common sense that a 15-day moving average will be more sensitive to price. It would be more appropriate to measure short-term momentum than using a 200-day moving average. Okay, you'll see what I talk about just now when we use different screenshots. By the way, those of you that are new to the webinar, any questions you have, just type them up. Yes, I can see you guys all hearing me. Great. Thank you. Just type up in the little question box, and as we go along, and also try and just keep those questions short, because obviously the short and to the point, because that little question box is quite small. And obviously, we can get to the point straight away. If I can't get to the questions, I'll answer them in the presentation. If not, I'll email you. Secondly, obviously, this presentation is being recorded, so those of you that are on this webinar will be beginning the presentation as well as the recording. Gerard has a question about calculation of the MA. Yes, I'll be getting it in the next few slides, discussing a simple moving average and all those the differences as such. So I'll get to it just now, Gerard. Okay, to answer your question. Momentum, okay, one of the best ways or methods to determine the strength or direction of a momentum is to place 3 moving averages on a chart, and I use that a lot. Pay close attention how they stack up in relation to each other. You'll see just now we talk about multiple moving averages, and the crossover of these moving averages will help us determine the different time frames. But basically a strong upward momentum is seen when a shorter moving average, like a 5-day, crosses over a 10-day, and the 10-day crosses over the 20-day, okay, or even a bit longer. And also, secondly, when those longer term moving averages, be the 10-day and the 20-day, start widening and diverging away from each other. And obviously the opposite applies also in the downward momentum, when the shorter moving averages are trading below a longer term moving averages, and those are diverging. Okay, this is what I find the main use, or what I use moving averages a lot for, especially for day trading, area of support and resistance. Obviously, when the prices have been falling, we meet an area where the market stops and reverses direction, and it's at that point, it's usually, for example, the 200-day moving average acts as a very, very important support level, and usually we anticipate a bounce from that. And usually we also use other technical indicators to confirm that we are at the bottom of the cycle for confirmation. Okay, so I use 200-day moving averages a lot, and especially also together with a 50-day moving average. I use them for price projections, for price targets. Okay, so they're very, very useful in establishing, obviously, entry level at the bottom of the cycle. But also on the other side of the equation, resistance, once the price has fallen below influential level, or support, again, like the 200-day moving average, you'll see that this will act as a very strong barrier. Okay, so previous support will become resistance, same thing here. So this is where we'll take your take profits or your close out your long positions. Short sellers on the other side would enter a trade at these levels. Okay. Stop loss, as I mentioned just now, also entry levels and stop levels. So support and resistance help us to manage risks. Okay, so it identifies strategic places where to place your stop loss order. So you've seen in the graphs just now, these things all come together. So the idea, obviously, of a stop loss, you want to be able to cut off any losing positions, and obviously you don't want to have your losses grow any larger. So you'll set your stop loss order in a long position just below an influential moving average, like a 200-day moving average. Okay, I try and tie it together up with actual support and resistance levels on the actual chart, and I use the moving averages together with that. And obviously, if you do that, you'll save yourself a lot of money. So you want to incorporate your stop loss into your trading strategy. Okay. So let's just quick some background, and let's come to the differences between the different moving averages. Obviously, there's a whole lot of moving averages. I know, like, for example, I went software, you can more than 8. I'm just going to discuss the 3 popular ones: the simple moving average, the exponential moving average, and the weighted. Those are the 3 I use the most. Okay. So a simple moving average, as it would explain, it's the simplest form of moving averages. All it is, you're dividing the sum of a number of daily prices by the number of days added. Okay, so I want to calculate a 5-day moving average. I added 5 days divided by 5. I'm still pulling up an average. Okay, so the main differences between all these things is the weighting. So a simple moving average carries equal weighting. Doesn't matter if you're looking at the first, middle, or last day. It has equal weighting, and you'll see what I mean by that. So here's an example. We've got the share price over a 10-day period going from 102 cents, and it drops every day, 98, 95, 96, 94, and it starts reversing, 97, 103, 105, 101, and so it goes down. So what do you want to do now if I bring in my little highlighter here? You add up those 5 days here. Okay, add them up, divided by 5. Okay, we add them up, and our total is, our sum is 485, divided by 5, because we're working on a 5-day moving average, and our moving average value will be 97. I always look at it this way. It's just, you know, if I had 5 numbers, 1, 2, 3, 4, 5, I add it up, the middle number will be the 3. Okay. And so what happens, we start plotting this on a graph now. Then the share prices, how they're going up and down, and I start plotting the moving average on top of that. So to calculate a 5-day moving average, as I mentioned just now, we add up the last 5 days divided by 5. So that's what we were talking about just now, and now that's how we start plotting it. Sooner or later, the share price has to cross over the moving average. When it goes above it, obviously a buy signal. When it comes down through to sell signal. So in this situation, a sell signal is given when a buy signal is given when the price is higher than the moving average, and you'll see in the next screen where I'll talk about that. And sell signal is the other way around when the moving average is greater than the share price. So there we go. The share price on that day was 103, and the moving average on that day was 97. That was my buy signal. Okay, confirmation, change in trend. We're going from a downtrend to an uptrend. Vice versa, we're going from going from an uptrend to a downtrend. The moving average is above the share price. That will be a sell signal. Very simple. Obviously, when you get this presentation, just to review this information again. The biggest challenge is deciding the time periods. So this is out of the textbooks. They say very short time periods. It's anything between 5 days and 13 days. Short term, from 14 to 25, 26 to 49 would be a minor intermediate period. Intermediate periods, 50 to 100 days, and long term, anything from 100 days to 200 days plus. Okay. So that just to give you some idea. When it comes to moving average periods, you must just play around with yourself, play around with the moving averages yourself. Okay. So when it comes to it, obviously, it's a critical decision, deciding on those time periods. Obviously, with hindsight, you have made a much better decision. But I find there is a bit of a some benchmark suggestions. A lot of people do use the 200-day moving average or 39-week. It depends which way you look at it. And this is always at a good track record over the long term. But there's a bit of a formula. What it is the market length that you're looking at divided by 2 plus 1. So let's say, for example, you look at a market length, market period, and I usually calculate the troughs from one low to another low or extreme low, and I calculate that. I divide that by 2 plus 1. So here we go. Here's an example of Sassel. Some people calculate the troughs, some people calculate the peaks. Doesn't matter which way you do it. It gives you a bit of idea. So from there to there, okay, that was 48 days divided by 2 is 24 plus my 1 gives me a 25-day period. And from that low to that low, it was a 30-day period. So between a 25-day and a 30-day, you might want to choose that. But just based on a 5-day moving, 25-day moving average, there's the share price. You can see how it smooths out the trend. Because you see the share price is obviously volatile. So if you had to overlay it over the moving average to smooth out the data. So the interpretation is when it goes up through the moving average, you'll buy. When it comes down through to sell. Ideally, you want the moving average to be also pointing down. So that could have been a bit of a false signal over here. Okay? Because the moving average is still pointing up. There, when it goes up, you'd buy. When it comes down through the again, you can see it's not really pointing down yet. Okay, so this is where I like to use 2 moving averages, and we'll get to it just now. That's a simple moving average. It's just taking the last 25 days data, adding up 25 days data to get a moving average. So you add up to 25 divided by whatever the period is, and then adding on as we're going along. That's what's called a moving average. Exponential moving averages, the big difference is it's a fractional average. You're taking a fixed fraction of the previous result and adding that fixed fraction to the current close. So you're multiplying by exponents. You're just giving them the latest information or weighting. Okay, that's one of the criticisms against the simple moving average, that we're only taking account of the whole period instead of the most recent data. So the exponential moving average, it looks at all historical data, but obviously gives the latest, the most recent information more weighting, if you want to use that word. But saying that, they did some research and they found out of the 3 moving averages, they're all very much similar. They actually found that the simple moving average works better in the futures market. you'll see just now when we start comparing the three of them together, there's pros and cons. Okay, so you've got to compare a simple moving average against the exponential moving average. You can see there, exponential moving average hugs the share price closer. Okay, so it's more sensitive than the SMA and hugs it closer. So there's pros and cons, but they're both getting very much the same time, okay, and getting out very much the same time. So, much of a muchness. Just that the exponential moving average, I find is a bit more sensitive. It hugs the price closer. The weighted moving average, a lot of people like this one. All it is very similar. Again, you're giving more weight to more recent data and less weight to the past data. So in this situation, like for example, on the first day we multiply by 1, okay, and on the last day we multiply by 5. We try to calculate a 5-day moving average. In other words, the most recent data will have 5 times more weight than 5 days ago. So this is how it would look like. Very similar. Okay, it gets you in a bit earlier, gets you out a bit earlier. It also hugs the price a bit closer. Okay, so it is more sensitive than both the EMA and the SMA and slightly earlier signals. But saying that, I personally prefer exponential moving average just because it takes more historical data into place. Okay. This is where it's powerful, when you start adding all these, using different time periods, moving average crossovers. So just by looking at a simple moving average by itself, you get a lot of what they call false signals. So using a combination of different moving averages, you get more accurate buy and sell signals. Okay. So what's important is to eliminate those false signals. And also, some people like to use a bit of some rules. We talk about a valid penetration. So some people like to use a 3%. The share price must close up at least 3% above it or below it. You ignore anything else. Okay. So the whole idea is that you can either use the price in the moving average, and the idea here is you're moving in the motion. It's telling you the price is above or below. If it's the price is below moving average, obviously it's the beginning of a downtrend. If it closes above, if the share price closes above a moving average, it suggests a new uptrend. So it eliminates that human emotion. But also, obviously, the whole idea of moving average crossovers, it identifies the shifts in momentum, and this is where it helps you for basic entry and exit strategy. So we'll come back to it just now and talk about different entry and exit points, but that's a one way, the price relative to the moving average. Alternatively, it's the crossover of two moving average periods. A short term crosses over long term. 5-day crosses over 10-day. 21-day crosses over 40-day. 50-day crosses over 200-day. Doesn't matter. The buy signal is when the short term crosses above the longer term. That would be the buy signal. So remember, the very objective is to get that signal, and that's why it's so popular. So here we go. This is what I say. I like to use a 50-day and a 200-day moving average. Disadvantage is in the sideways market. So you'll see in the next graph how you compensate for that. Basically, when the 50-day crosses below the 200-day moving average, all the textbooks, they talk about a death cross. So anything below the 200-day moving average, this is bad news. So we've got a downtrend. When the 50-day crosses above the 200-day moving average and they're both pointing up, we have what they call the golden cross. Anything above that is good news. Okay, so these are the two moving averages I use a lot, especially for trading. Anything above a 200-day moving average, you should be more in the long position. If it's below a 200-day moving average, you should be more on the short side. Okay, remember we're talking about probabilities. So coming back to my example now, how would I compensate for sideways market? Obviously, I'll use my trend lines. Here's a resistance trend line, a support trend line, so helps me with that channel. I want to see a breakout of that moving average. Okay, so there's my moving average confirming, but also my MACD. Remember, MACD stands for moving average convergence divergence. So again, it's two moving averages, the difference between two exponential moving averages. So moving averages are used a lot of things. So that will give me the buy signal, or that's the move. We're going from a sideways market to an uptrend. Okay. So a lot of people use triple moving averages. I use it myself. A 5-day, a 10-day, and a 20-day. When the 5-day crosses over up through the other moving averages, that up through your 10-day moving average, that will be your primary buy signal. And ideally, you want further confirmation when the 10-day crosses above the 20-day moving average. Okay, so the whole idea here, by using multiple moving averages, you're going to reduce the number of false signals. Okay, by increasing the number of moving averages, obviously it's the best way to gauge the strength of a trend. And I'll talk about an indicator just now that I'm doing more analysis on. It's a guy called Darryl Guppy in the States. He's called an indicator called Guppy, Guppy. It's his surname. And he uses multiple moving averages, and you'll see in the next graph. So here we go. There's the 5, the 10, and the 20 day. So when they all cross together, there we go, cross over each other. That'll be the buy signal. When it comes down through again, you sell. There we buy, and then we sell. Okay, we buy and we sell. So we're taking advantage of most of the cycle. Okay, and that's the kind of thing you're looking for. Okay, again, same chart on Sassel, by using smaller moving averages, but just the crossovers. Okay, let's move on to the next screen. So many questions coming through. Mike Tyler, hello Mike. When to use the simple, when to use the exponential. You must decide for yourself, Mike. I just personally, you can see all my graphs here. I'm using exponential all my charts. As I say, they hug the price closer. So it's for you to experience. As I say, some of the textbooks say the simple moving averages are better for futures trading, and I know you do single stock futures trading. I use exponential moving averages all the time. Okay, so it's different one to explain. Try that for yourself. Find out which is the best for yourself. Okay. Let me go back to my cursor here. Okay, this is what I was talking about Guppy. All he does, he uses 11 multiple moving averages, 5 short ones and then 6 long-term ones. What I find useful about this, basically the analysis is the traders and the investors are agreeing on price and also agreeing on value. When the two of them cross, like we're seeing over here, you're getting very, very close to a good confirmation of a changing trend. And there it tells us the traders are still getting in, but the investors are still holding out. So you could erode this whole cycle out all the way up to here when they compress again. Okay. So very, very interesting. We can go Google up on Guppy, Guppy multiple moving averages, MMA, and interesting stuff. I like to do further analysis on that. But interesting stuff when it comes to multiple moving averages. Okay. Before we hit any more questions, let's quickly discuss Bollinger Bands. Obviously, Bollinger Bands, most of these indicators come from the creator. In this situation, John Bollinger, very well-known technical analyst in the States. Bollinger Bands are very similar to what they call trading bands or envelopes. The main difference between the two of them, trading bands and envelopes are plotted at a fixed percentage above and below a moving average, whereas a Bollinger Band is plotted as a standard deviation above and below a moving average. Now, standard deviation is just a measure of volatility. So you find that these bands are self-adjusting. They widen when there's volatile markets, and they contract during calmer markets. So Bollinger Bands are usually displayed as overlaid over a security, be it a bar chart or a line chart. But I also use them on indicators. I use them on RSI a lot. Okay, so you're looking for those extreme movements. But John Bollinger basically said that prices tend to stay within the upper and lower band. Okay, what you want to do is when they move outside those bands, that's when you're going to get excited. During periods of extreme volatility, price changes, obviously those bands widen. Okay, and during when it gets a bit calmer, less volatility, and obviously those bands narrow. But you'll find that the prices usually stay within those periods, but there's times when they get outside it, and that's where I believe there's opportunities. Okay, so the move usually goes from one band, from the lower end, all the way to the other side, and that's obviously you can also use for price projections. So John Bollinger recommends using a 20-day moving average, and again, it suggests using a simple moving average. He thinks anything less than 10 days doesn't work so well. So here we go. Here's a moving average. There's our moving average in the middle, 20-day moving average. And then I've got 2 standard deviations. So you can see that here we get very close to the bottom of the cycle, and we ride the cycle all the way to the top. Okay, comes down to the lower band, rides all the way to the top of the cycle. Gets to the bottom of the band, rides all the way to the top of the cycle. Okay, so that's what you're trying to do, is try to ride the cycle, ride those long-term cycles. Here we get to the bottom of the cycle, all the way to the top. Okay, then we pull away back again. Okay, so what's important is obviously when there's the turning point, and that's where you can use other indicators as further confirmation. But this is what point I'm trying to make. I'm trying to get into the lower band, it rides all the way to the top. Lower band all the way to the top, and that's where it's powerful. Okay, so again, just using moving averages and then building on from that. Okay, quick summary quickly. Obviously, there are very few technical indicators that are as popular and widely followed as moving averages. The underlying purpose, obviously, is to help you track the trend, obviously smooth out the noise. Simple moving average, we're looking at arithmetic mean of a given set of values, so be it a 5-day, whatever the case might be. Exponential moving average, I'm just giving more weighting to the most recent data. Primary role of moving averages, obviously trends and reversals, momentum, support and resistance. But also I find it very useful for stop losses. Remember, the major disadvantage is a sideways market. It doesn't work well in the sideways market, so you have to compensate for that. And that's why I believe moving average crossovers can eliminate those false signals. Obviously, moving average is also used in a lot of other technical indicators, with for example, the MACD and Bollinger Bands and things like that. But it's a very, very useful tool in your trading strategy. Okay, that's a quick summary. Before you take any questions, let's quickly highlight our upcoming webinars. Next week, we're going back to fundamental analysis. We're going to discuss value investing. This is like Warren Buffett. He's a value investor, so we can discuss some of his thinking and his methodology. The week after that, we're going to talk about some risk management. This is more to do with a equity portfolio. I talk about the 3 S's, the structure, the spread, and your stop loss. When we come back to technical analysis, we'll discuss cycle and trend analysis, which fit in nicely what we discussed today on moving averages. And at the end of March, we go back to fundamentals. And we start bringing in the different financial statements. This one, we're going to discuss the income statement, how to analyze the income statement, what financial ratios can we look at from there. Okay. Those of you that are in Pretoria, our Traders Forum, first one for the year. It's on the 11th of March, Tuesday 11th of March at Centurion Country Club. The topic as such is technical analysis and trading. So we can look at moving averages and all those other things and how to incorporate that into a trading system. And then I'm repeating obviously the same presentation down in Cape Town. So you guys in Cape Town, I'm coming down the end of March. Remember both these presentations, you have the opportunity to have snacks and drinks with all the participants. Nice opportunity to network. Okay. So quickly, this presentation will be sent out to everybody. Any questions you have, I prefer if you can put it up on our Facebook or Twitter pages so we can get some the ball rolling there. The graphs I used today all comes from my Went software. As I say, there's got more than 8 different moving averages. Very simple entry-level program. The software is for free. You just subscribe to the download service. So look out for our upcoming webinars. There's still place to book. Obviously our Traders Forum. And from my side, good luck and happy trading. Let me see if there's any questions coming through here. Very long questions. Okay, pleasure, Alex. Good stuff. How do you combine this into trading? Yeah, that's where I'll be discussing a lot at the webinar, with the Traders Forum next month. But the idea is that incorporate this as part of your trading strategy. You still want to look at entry and exit levels. I use support and resistance levels. But the main thing here is you want to trade in the direction of the trade, and moving averages helps you to do that. Okay. Okay, went offline. Now you'll be getting it. Willie, pleasure. Thanks. Thanks, Emil. Thanks, Jacques. Very informative. Thank you. Okay, guys. So I hope you've enjoyed it. I hope you found it was insightful. But again, just to play around with these moving averages to find out which is the best one for you. There's my contact details. Any questions you might have, welcome to phone me. Ideally, maybe email me with screenshots of the charts you're looking at, and we can discuss it from there. So thanks for your support. Thanks for attending this webinar. Until next week, enjoy the rest of the time. Thanks. All the best. Bye-bye.